All right, let's dive into a pretty provocative idea. What if your bank doesn't actually want you to get rich? We're going to break down the powerful and often kind of hidden financial reasons that show how banks can profit the most when their customers are just scraping by. Let's get right into it.
It seems like a weird question, doesn't it? I mean, we're always told that banks are our partners. They're there to help us build wealth, to grow our money. But what if their success and your success aren't actually linked? What if the numbers tell a completely different story?
So, where does this all begin? Well, it starts with a simple, pretty much unavoidable cost: fees. For millions of people, just having a bank account with a low balance means you're already paying for the privilege. You're starting at a disadvantage from day one.
And just look at the difference here. It is night and day. For a low-income customer, banking can feel like a constant leak in your wallet. You've got monthly service fees, overdraft penalties, ATM charges. It all adds up to almost $50 a month just gone. Meanwhile, a high-income customer, they often pay zero of those fees and they're actually earning money from interest. It's like two totally separate financial worlds, all inside the same bank.
And this isn't just numbers on a spreadsheet. This quote from Juanita Smith, it really puts a human face on it. A $1 mistake spirals into a $30 penalty. And that's a story that plays out all the time, showing just how fast a tiny misstep can become a huge expense for people on the tightest budgets.
Sooner or later, all the fees and the strict rules just become too much, and it actually pushes people out of the banking system altogether. And this leaves them having to rely on other services, like check cashing stores, which they often charge even higher, sometimes predatory rates for just the most basic financial stuff.
Okay, now let's talk about the next level of fees, the overdraft. What started out as like an occasional favor for a bank's best customers has completely transformed into a massive, automated profit machine.
And when I say massive, I am not kidding. In just 1 year, big US banks raked in nearly $12 billion from these fees. This isn't just some little side hustle for them, it's a core part of their whole revenue model.
So, who is footing this enormous bill? The imbalance is just staggering. It turns out that only 9% of account holders, a tiny fraction of customers, end up paying 80% of all overdraft fees. And these are overwhelmingly people living paycheck to paycheck, the very folks who are most vulnerable to a simple mistake in timing.
So this is where we really have to change how we think about an overdraft. It's not just a penalty for messing up. Functionally, it's a tiny, very short-term, and incredibly high-cost loan. That fee isn't a fine, it's the interest.
And just how expensive is this so-called loan? Well, think about this. If you overdraft your account by just $15 and you pay a $35 fee 3 days later, the effective annual percentage rate, the APR, is over 10,000%. No, that's not a typo, 10,000%. That's way beyond even what the most infamous payday lenders charge. And it gets worse. According to regulators, some banks have actively worked to make these fees happen more often. We're talking about things like misleading customers into opting in for these services, processing your daily transactions from biggest to smallest to drain your account faster, and even putting long holds on your deposits so your money isn't available when you need it.
But you know what? As enormous as the overdraft business is, it's actually small potatoes compared to the main event. Now we're getting to the real engine of profit for consumer banking. I'm talking about credit card debt. This is where the whole business model really comes into focus.
It all comes down to one thing: interest income. The money that banks make from customers who carry a balance month after month, well, that's by far the biggest moneymaker for the entire credit card industry. It's not even close. So inside the industry, they basically split credit card users into two groups. First, you have what they call transactors. These are the people who pay their balance in full every single month. They generate almost no revenue. But then you have the revolvers. These are the people who carry a balance, paying that interest month after month after month. These are the ideal, most profitable customers. The whole business is built around them. And here's what that trap looks like in real life. Let's take an average credit card balance. If you only make the minimum payments, you could be in debt for over 14 years. And the craziest part? You'd end up paying almost as much in interest as you originally borrowed, essentially doubling the price of everything you bought. So when you start to put all these pieces together, you've got the fees for having a low balance, the super expensive overdrafts, the crushing interest on credit card debt, a pretty big question starts to form. Are these just isolated problems, or are they actually features of a system that's working exactly the way it's supposed to?
You can actually see it as a kind of profit pipeline. It starts with low balances, right? That triggers maintenance fees. That financial squeeze makes overdrafts more likely, which creates huge profits. And finally, this cycle of fees and debt often leads people to rely on revolving credit card debt, which is the biggest and most reliable payday of all for the banks.
What this all points to is a really deep fundamental conflict of interest that's just baked into the system. The more a customer struggles financially, the lower their balances, the more they overdraft, the longer they carry debt, the more money they make for the bank. Their financial struggle becomes the bank's profit center.
Which brings us right back to that first question we asked, but, now with a whole new light on it. Once you understand how your bank actually makes its money, you really have to ask yourself, who is this system really built to serve? Thanks for watching.